Today, we're here to learn about the accounting equation, mainly assets, liabilities, and equity. So I hope you enjoy this video. So there are three main types of financial statements. We have the balance sheet, income statement, and the statement of cash flow. So in the previous episode, we were learning about the income statement and how to calculate profit and loss. So these statements are important because they're used by creditors, the government, investors, and the owners to get a better financial picture of the company. So let's take a look at what the accounting equation is all about. It's a fundamental concept of bookkeeping, recording transactions, and how we organize our books. So basically, we've learned in the last two episodes about the role of transactions in a company and how transactions affect the financial picture because there's an exchange of money, we buy and we sell things. So the value of the organization is going to change. So transactions fall into three types of categories, and we set up these categories so that we can place our information and our numbers into these sections. So we have our assets, liabilities, and our equity. So the accounting equation is our assets minus our liabilities is equal to our equity. So as a third party or manager or owner, it's interesting to see what the company owns, what they owe to third parties, and how much stake the owner has in the actual business. So what are assets? Assets are things that have value and they're owned by a person or a business. So you probably have assets, I have assets. They are resources controlled by an individual or business as a result of past events, and there's going to be some future economic benefits. So in this case, we have cash, vehicles, building. These are all examples of potential things that a business can own, and it can drive future value because you can use the car to go to a client's place or to do deliveries, and you can own a building because that's where you work and that's where you're going to create a lot of value for your customers. Here are some examples of some assets. We have banking cash, so we have money in the bank or on hand. We have accounts receivable, inventory, property, plant and equipment, and intangible assets. These are all things that a company can own and they have value associated with them. Inventory is like the goods made available for sale. So if you are a toy store, the toys that you're going to sell is inventory and an asset to the company because it has value and you're going to sell it in exchange for some cash. Accounts receivable is a concept where you sell things to customers. They don't have a lot of cash on hand, so they're going to pay you back in the future. So you're going to sell on credit. PPE stands for property, plant, and equipment and includes other things like fixed assets such as land and building. And finally, we have intangible assets, brand and goodwill. Some companies have a lot of brand and goodwill, such as these big companies with like Walmart, Costco. People associate some good connotations and value with the brand, and the name itself possesses some value, and we can sort of put a monetary value on that. So these are things that a company can own. We need to subtract what a company owns minus what they owe to other people to properly calculate the net value of the business. So liabilities are debts or amounts that are owed to others. So if you purchase an asset and you may not have used all of it, there could be still a debt or a liability. For example, if you purchase a car but you purchase it with a liability, it's still an amount that you owe to specific people. So examples of liabilities: you purchase goods or services with the promise to pay. You can have taxes, payroll taxes, income taxes, bank loans, wages payable, and mortgages. So these are amounts that you owe to other people because you need to borrow in order to buy things to create value for your business. So if you were a restaurant, sometimes you need to purchase goods such as ingredients, but you may not have the cash up front, so you're going to pay later and you're going to buy on credit. So these are examples of things that we can owe to other people. And to calculate our net worth, we calculate all of our assets, subtract all of our liabilities, and we calculate our net worth. So what a business owns minus what they owe to other people, third parties, is what the owner can claim, which is the owner's stake in the business. So what they own minus what they owe is the value of the company and what the owner can claim. You can also move the liabilities to the right side. So assets minus liabilities is equal to our owner's equity. However, we can move the liabilities to the other side, and assets is equal to the liabilities plus the net worth or equity. So I'm just moving around the equation. So what they own minus what they owe to third parties is equal to the owner's stake in the company. So I'm just going to go over an example called Mark's Repair Shop. Mark's Repair Shop has been in business for several years and specializes in fixing small appliances, toasters, shavers, fans, and ovens, and other things. So here's how we can determine his net worth. So he has some assets, some credit and debt, and some very big assets. So he might provide us with a list of things, and we have to calculate the net worth. There's some cash, a loan for a truck, mortgage payable, inventory, building and land, accounts receivable, supplies, equipment, and accounts payable. So if we were to calculate the net worth of the company, we have to first organize these items into assets and then liabilities. So I've done this for you already. The pink reflects the assets, the blue represents the liabilities and what he owes to other people. And we can calculate net worth, but first let's calculate our assets. We add the cash, accounts receivable, supplies, inventory, equipment, and finally building and land, and we get a total value of $219,600 for the assets. So these are things that he owns and he possesses, and they're expected to drive some future benefits and value for the company. There are also liabilities, things that he owes to third parties. It should be owes to third parties. So we have accounts payable, bank loan, and mortgage payable. Accounts payable, he probably borrowed some services. So for example, utilities, maybe a little bit of rent. So these are things that he owes to third parties, and these are the total liabilities. And now we can calculate the net worth, the owner's claim. We simply subtract the assets with the liabilities, and that is his owner's claim or net worth of the company. So anytime a transaction happens, it's going to impact these three things. So if we look back at all of these different items, let's say he purchased some more inventory, the cash is going to go down, but the inventory is going to go up. And we could also purchase some supplies on credit. So the supplies are going to go up, and the accounts payable, which is a liability, is also going to go up. So we have these accounts and we have the system here with the accounting equation, and this is going to help us organize all of our transactions and make sure everything is properly and neatly recorded. So here are some basic calculations if you want to try it out. Assets, liabilities, and equity. The answers are over here. So for example, 88,000 minus 30,000 is 53,000. As long as you have the accounting equation set up, it's really easy to calculate. What you own minus what you owe to other people is equal to the owner's stake or the net worth of the company. And you can rearrange this equation so that you can have just assets on one side and liabilities adding to your equity on the other side. Now let's try a little bit of a more complex problem. We have assets on this side, liabilities, and equity. Suppose during this year our assets increased by 70,000 and our liabilities decreased by 50,000. So what is the overall impact to this company? We can create a grid to help us analyze the changes in this business. So before we have assets over here of 150,000, we have liabilities of 70,000 and equity of 80,000. So the change is that we have an extra 70,000 in our assets. Our liabilities went down by 50,000. So if our assets go up, we own more. We have more value to the company, and our liabilities went down, so we owe less to other people. So if we own more and owe less, we're going to have a positive effect on our equity. The owner is going to have more claim to the company. So our assets went up to 220,000, our liabilities went down to 20,000, and our total equity went up to $200,000. So this video was about understanding what assets, liabilities, and equity is. So assets are things we own, and they have future benefits, and they're going to be driven to the company. Liabilities are things that we owe to third parties, so this is going to decrease the value of our company. So the net worth is calculated by calculating what we own, subtracting what we owe, and that is going to be the owner's claim to the company. So I hope that helped out a little bit with the accounting equation and calculations. Make sure to like and subscribe to my channel for future content, and I hope you enjoyed this video. So I will see you later. Okay, bye bye.